appreciate your time and being here on our webinar that's going to talk about how to hire or change an advisor. I'm Cory Phillips, and
I'm Bill Engel.
Bill Engel, yep. And we're going to be here to walk you through some things. We have some quick housekeeping items that we'll jump into here in a second. But basically, there's a questions area. So if you have something top of mind right now, before we even dive in and you want to write it into the chat, feel free. And we're probably going to hit all the questions at the very end and go over them then. But if we see one throughout and think it's a good time to answer, we'll jump in then and go from there. So just a quick, I'm sure there are some clients on here, as long as non-clients, thanks for being here. But quick overview of Fort Pitt Capital, 3 big things that I want to hit on. Our investment management, for instance, we have in-house investment management that Fort Pitt's invested a lot of money into. Our asset management team is about 7 folks with technology, and we use a fiduciary approach with that. We do offer a team-based approach, so it's a boutique feel. We try not to have one person wear too many hats. So, there's planners, the investment group, advisors like Bill and I, and service operations all around that. And we do try to be on top of things as much as possible, get back to clients within a day, meet with them regularly, and discuss throughout all stages of their lives. So a few unique things about Fort Pitt. We can get into more later if appropriate too. Just a quick piece about our webinars. So we do like and enjoy giving back to the community and offering anything that we may know that others may not. And we are life advisors. We want to be life advisors for our clients. So, all things financial, whether it's a mortgage, car, investments, planning, you name it, we want to be a part of all of their.
That's right. Yeah, we don't want our clients having to reinvent the wheel or make decisions in a vacuum. Anything that affects their financial life, we'd like to be involved with.
Definitely. And we oftentimes do work with CPAs, state attorneys, you name it, lots of professionals that are a part of someone's finances. So yeah, it's all part of the team-based approach, really. So a bit about me, I found this career actually when I was in college. I was kind of unsure what I wanted to do. I started in engineering, was doing pretty well in it, but was doing soul searching and not really sure which path to go in. So I saw someone talking about a day in the life of a financial advisor, and it really piqued my interest. I went and introduced myself to him, and it really changed the trajectory of my life, and I'm really happy it did. I came from a middle-class family. Money wasn't always a topic at the dinner table, but it was sometimes. And I think through growing up and then finding this career, it put me in a spot where I now feel like I can help others maximize their dollars, maximize their retirement. So that really hits home to me. Born and raised in the South Hills, and started in the business by knocking on doors actually to build my practice. So if I knocked on your door, hello again, I guess. But yeah, I like to hike, explore, play sports, compete, and do all of those things. So, and Bill?
Yeah, so I have been with Fort Pitt Capital for coming up on 9 years. I'm now one of the partners as well, but had a couple of stops at some other firms prior to this. So I've got about 20 plus years of experience in financial services industry. My first career was in the technology industry, so I have a little bit of a unique background and insight into things. But my education, I wanted to be a college professor. The idea of being able to educate and speak about things that I was interested in to a captive audience seemed like heaven, and I kind of found that I can do that now, and so I love what I do, and also born and raised in the South Hills. I have a wife and 3 kids, and our last one we were just talking about is in high school, so we're getting through to the other side, but not quite there yet.
So some quick housekeeping items. Some of you are on a device right now, smartphone or iPad, whatever have you, and to ask questions, you'll see this arrow is kind of pointing to that area. You just click on the questions area, type it in there, and submit them at any time. If you're on a computer, it looks a tad different. You'll see this kind of box to the right that shows, handouts, which we do have one available for this webinar, just kind of showing how we work with folks in different areas, and then you can ask questions similarly to a device in that spot to the right. So let's dive in. The right advisor at the right time. So this slide really talks about different stages of your financial life, right? So if you're just starting out, or if you're at the very end of your working career or deep into retirement, there's a good so there's plenty of good topics to talk about throughout all of those times. They're different for each person and at each time. So we highlighted some areas here, but I kind of want to throw this to Bill and talk a bit more about what you see with this.
Yeah, I think the theme of this slide from my perspective is that it's never too early and it's never too late. When you're talking about just starting out, a lot of our clients have kids or grandkids, and those folks maybe don't think that they have enough money to think about working with an advisor. But when you talk about how important decisions can get amplified, obviously when you have a lot of money, any decision can be amplified by the scale of the money, right? But when you're just starting out, it can be amplified by the time horizon, right? And so the little analogy or story I like to tell about it is when you're 22, 23 years old, and if you had the next 35 years of your life to get from Pittsburgh to California, you didn't really know how to get there, but you figured I got plenty of time to do it. If somebody pointed you in the right direction and gave you kind of guardrails to get there, you'll probably get there a little bit more quickly and efficiently than if you wander around for a little bit. And so you're in your 20s, your 30s, that's the time when how much money should I be putting away? How much should I be putting towards savings or an emergency fund? Those types of things. And that can really matter over time. As your life gets a little bit more complex, the decisions get a little bit more complex, and that's where bringing an advisor in can really matter. And then certainly when your assets reach sort of that critical mass, and we'll talk about that coming up, but that's when the margin of error really starts to shrink, and it becomes very important to have somebody that's helping you along. But again, I think the important thing here is never too early and never too late.
So to go off of that, some common life events that where you may want to speak with a financial advisor, it could be a good time to do so is when you're nearing retirement. A lot of big decisions are coming into play at that time. Changing jobs, whether it's first change or fifth change, we have a lot of old 401ks out there that may have a lot more options to do things with. Selling a business, huge life event. Inheritance from family, friends. If you're recently widowed, realizing, to Bill's point that he was just mentioning, that your portfolio has reached a critical mass, and being overwhelmed by recent market volatility. All of these could lead to, hey, it's time to talk to a financial advisor. And I'll just touch on one of these now that Bill just mentioned it, reaching a critical mass. So, it's easy in two cases, I think, to trade and be a self-guided, self-taught investor. One is the stakes aren't as big. Maybe you're trading with 10 or 20 or $50,000, or two, when the market's just going straight up, like we experienced just recently.
Absolutely.
In the first case, if that changes and now you have $1 million, that's your life savings to trade with, stakes are a lot higher, and it's hard to make those buying and selling decisions just on your own. Am I really right about this? Am I sure this is the right thing to do? And the other part of that is markets are flattened. We had not the best year for most investments last year as a whole. or down? Do I really believe in this stock now that it's down 20%? Will it ever come back? What more details and analytics we need to go into? That's kind of where things can get a little murky and tricky for the common individual investor.
That's absolutely right. I mean, it is cheaper and easier and more convenient today than ever before to manage your own money. The tools are out there with the internet, and a lot of the costs have been compressed significantly. So, but we are all still subject to the same sort of behaviors and emotions. And one of the advantages that an advisor can or should bring is discipline. That I mean, I love telling my clients, I don't manage my own money. I feel just as bad as they do whenever I see red arrows, right? And so, but having somebody who's not going to react to those things is a big value. So, but I think the big thing about this slide is these are all events. Some of them are things that are going to be able to be planned for, some of them not. But Cory, you and I are planners, right? And so we always want to look ahead. And my advice to people is don't wait for these events to then start to make your decision, because none of us make good decisions when we're under the gun or under duress. So in as much as you can, plan for it. Do your due diligence when you're a couple of years out. If you're not working with an advisor and you plan to retire in a couple of years, now's the time to start talking to people and make sure that when that event actually happens, it's kind of a non-event because you've already done the work up front.
Sure. It's really not pleasing, if you're planning to retire next month, or you just submitted your 2 weeks and then you have your planning meeting with one of us, or you look more under the hood and you're like, man, this might not work for retirement. That's not a good position to be in. So if you do that in advance a bit more and know when your date is, what amount you will need, what your portfolio can generate in income, you're much better off.
That's a really good point, Cory, too, is that particularly with selling a business, a lot of times business owners, entrepreneurs, they've got their head down for years just working in their business, and then somebody comes along and offers what seems like a really big number, and it gets enticing, but it's normal and reasonable to not really understand what that means. And so talking to somebody up front, an expert like we are, who can say, well, this is what that's going to mean for you, Cory, when you sell your business and walk away with your money. Maybe you need a bigger number, or maybe you thought you had to work in your business for another 10 years, but you can get enough now. Having that information at your fingertips before it's too late, and you're sitting at the table and they write you this big check, and after taxes and everything and all the different people you had to pay, you're like, this is all I have. So again, it's all about planning and making sure that you know what you're doing beforehand.
Sure, that's a really good point. A bit about our investment process. So this is it from a really high level, I would say. I mentioned in the beginning of this presentation that there's 7 asset management folks down in our trading between Pittsburgh and Harrisburg, and there's hours and hours of brain work and molding and thinking and crunching numbers on what's the best stock to buy right now for what we're looking for, and which ones that we own need to be trimmed or added more to or sold out of. There's just hours and hours of it. I think it's a testament to what you said, that you don't manage your own money because of all of the work that would go into it. It'd be really hard for us to.
It's a full-time job.
Yeah, it's a full-time job. So that investment's huge. I mean, these guys or gals could be on investor relations calls each quarter to figure out what's going on and what management's saying. So not just the numbers and what a PE ratio is showing, but also, hey, do we believe in X, Y, and Z person to run this company and lead it for the next 3, 5, 10 years? So much goes into that.
Absolutely. And there are a lot of different ways to skin a cat, right? And we like ours, you would expect, but there's a lot of different legitimate investment strategies and investment vehicles out there. What's important is to understand what you're comfortable with, what you understand, finding an advisor that manages money in a way that is makes you comfortable, right? Is it active management versus passive? Or do they outsource it to somebody else, or do they do it in-house? What are the costs associated with it? It's all of these different factors can affect your results. So just knowing that and making sure that you're comfortable with how your advisor is going to handle your money. As I said, we think ours is the best. You would expect us to think that, but there are a lot of different legitimate ways. But we tend to attract people who understand that owning individual securities, there's a value to that, and active management, there's a value to that. We're not for everybody, but we're for a lot of people. And knowing that and understanding it as the client, you don't really need to know how the sausage is made, but you want to understand what informs your advisor's decisions and how do they think.
Definitely. So for clients that are on this call, you're likely already aware of this because we went through it with you at one point or another, hopefully. And for those of you unfamiliar with our process, Bill and I thought it'd be important to go over it today, right? So very first time we get together with somebody, we're typically both asking each other a lot of questions. We certainly have a lot of questions to ask them. We're gathering a lot of information, whether it be statements or numbers or things about their family. And when we get an idea of what we're planning for, what goal we're solving for, oftentimes retirement, we do write a investment or financial plan for those folks. And Bill and I will work with a planner that we have in that team and department at Fort Pitt and come up with what we think is best. Now, it doesn't mean that that's the exact way that we need to move forward, but Bill and I and other advisors here want to give our best advice for you. And regardless of if you don't like this or that, we can tailor things if we need to, but we are going to give you what we think's best. And we're not going to base it just off of your age. So that's part of the process, is when we're going through that plan, having that conversation. And from there, if we decide to work together, we start the relationship. And on an ongoing basis, we want to meet with folks. At a minimum, we try to meet annually with people, some a bit more often, some not as much, but annually is a good number to at least get as a guideline to talk about changes in your life, whether it's a job change or any of the life events that we mentioned before. It could be a really good time to meet and maybe make tweaks on we might need to make tweaks on an ongoing basis.
Right. Usually enough has happened both personally and on the macro level in a year to warrant getting together again. And there are a lot of different styles. A lot of different advisors have different ways of doing things. Some take a more one meeting close type of approach. Others, like us, take a more like a longer, more methodical and consultative approach. Again, either can be legitimate. What's important is, as someone who's looking to hire an advisor, understand what you're comfortable with, and if you're not going to be comfortable being pressured in the one meeting to make a decision, that's just fine, and you should be not pressured to do that. But if you're comfortable with that, then that might be fine too. But obviously, we think that getting to know our prospective clients and having them get to understand and know us is important. I always like to refer to step one as that first appointment as our first date, right? Mm-hmm. We're just getting to know each other and making sure that there's mutual interest, that there's a good fit on both sides, because we're looking to make a long-term relationship with our clients. And if we get off on the wrong foot, if we're not going to be a good fit, better for us both to know that early on, right? And then when it comes to step three, that's something that I think we at Fort Pitt Capital feel really strongly about, that we show you in a written investment plan, what we're going to do and how we're going to do it. And we just don't believe that anybody should hand over their assets, their portfolio, to somebody who hasn't shown them pretty clearly what they're going to do and how they're going to do it, because there are implications to that.
Mm-hmm.
I know you were mentioning before about taxation and things like that. That if the advisor is the type that's going to say, hey, we have a strategy that we believe in, we have high conviction towards it, and when you hire us tomorrow, you're going to be in our strategy.
Mm-hmm.
That's fine, but somebody needs to understand that and know that, so that if you're coming to them with a portfolio that has a lot of unrealized capital gains in it,
yeah,
well, there might be implications to that. The flip side is if an advisor says, hey, we understand that everybody's a little bit different and we're going to take a slower, more methodical approach, just knowing that up front and taking the time in this process to get to know each other.
Totally. The one thing towards the beginning of what you were saying is the long-term nature of the relationship. That's something to be mindful of getting into it. You know, that I think you want to choose your financial advisor and firm with the thought of, you know, I want to work with this person for the next so many years. So I haven't been doing it as long as Bill, but you know, in 2017, I got my first client and started working with them, and there's a number in that year that, you know, I still work with today, and that, you know, I anticipate working with them throughout my 30s, 40s, 50s, 60s, even if I'm still going at that point, knock on wood. But you know, yeah, it's a long-term relationship. You should both get along. You should trust each other, that you're being open and honest, and yeah, it's a key to the beginning.
Yeah, and for those on this webinar who are maybe in the process of deciding to hire an advisor, you don't want to have to do this a lot, right?
Mm-hmm.
Ideally, once you find somebody who is the perfect fit for you, and so it just it pays you to take the time up front to do the due diligence, to really understand yourself and what your options are out there, so that when you do make that decision, you're 1,000% comfortable.
Sure, and it's with the firm in person for years and years. So when you're in your 60s, 70s, 80s, even 90s, you don't have to think, geez, I'll have to switch firms or switch advisors again. It's something that will stay throughout.
Yeah.
So, so I do see a question that came in a bit ago that we're going to pretty much address in this slide, I think, and can go into it more. But someone asked or said, I would like to understand how to know if you need to change advisors and how to know how to choose an advisor. So I think these questions will help you in thinking, hey, have I asked my person this, or I'm thinking of hiring someone, what do I ask? These are some good questions for that. So around fees, very first one, what additional costs will I incur beyond your structured fees? So this one's key, I think, and I think it's like all of these questions, we'll say they're all very legitimate questions that you should and can ask your current or future financial advisor. Something I think of with this one is, in today's day and age, most or a lot of firms are fee-based, so charge a percentage of the account of what they're managing. But beyond that, what other costs are there? Do you manage individual securities? Do you manage funds? And what are the internal costs of those funds, right? When you make trades, is there a commission to doing so? Do you make money from doing those things? All very valid questions, and you should be comfortable with the answers. But yeah, what do you think, Bill?
Absolutely. I think a couple of things about this slide is, or this bullet is, fees matter, right? Mm-hmm. And they are a drag on your performance. They affect how much of your money you get to keep. And so it should be very clear to you, and you should understand completely what it's going to cost to work with somebody. But you also don't want to be penny wise, pound foolish. A lot of folks get kind of caught up in fees, and it's really the value of what you're getting for what you're paying. But the other side of that is that incentive does drive behavior, right? And understanding how your advisor is compensated, how transparent that is, how upfront they are about that, those things matter. And as you suggested, very legitimate things to come up early in the due diligence process. Ask these questions, and if your prospective advisor is not being completely forthright or is a little cagey about it or whatever, that's, I believe, a pretty strong red flag.
Absolutely, absolutely. And just be aware certain products may be structured in the sense where, hey, if you want to change it the next 10 years, in year 2, you have to pay a percentage to get out of it. In year 5, although it may be lower, you still have to pay a percentage to get out of it with surrender charges. Lots to be aware of, very valid and strong question to ask.
Yeah. A lot of times compensation will illuminate to you what advice you're getting might benefit the advisor more than the client, right? And so we joke that there are a lot of products out there that are sold and not bought, meaning that the advisor got really well compensated, and so they made a very compelling case for it, but it might not have been the best thing. So again, it's about transparency, and anyone that's not going to be completely honest and forthright about how they get paid, that should be a red flag.
Totally, totally. From an ethics standpoint, when are you held to fiduciary standards in our relationship, and when are you not? Some firms operate that they're only and always fiduciaries, similar to Fort Pitt Capital. That's how we operate. We are fiduciaries. Some firms have different platforms where you can be a fiduciary sometimes and not a fiduciary other times. And some aren't at all, right? Being a CFP, Bill and I are both CFPs. So not only are we in the line in industry where we're fiduciaries as registered investment advisors, but CFP also has the additional governing body or a way of looking at things that want to keep you within certain paradigms and make sure that you're doing everything in the best interest of your client, right? That's really a fiduciary. Do what's best for your client. And at Fort Pitt, we both really are. But yeah, what do you want to add to that?
Yeah, you worked for a place prior to joining us where you weren't a fiduciary, but you're a good guy. We found that most advisors out there are good people that want to do what's best for their clients. But when you choose to work with a fiduciary, you sort of take the risk of that off the table. We are held to that standard and obliged to follow it. And so potential conflicts of interest that are out there, if you work with a fiduciary, you can know and feel confident that we are obligated to always put our client's best interest ahead of our own. Mm-hmm. And again, it's about motivation, right? And transparency about those conflicts of interest. We can never sell anything that benefits us more than it benefits the client. So if you're the type of person that might be a little suspicious of or a little less trusting of an advisor, and you be questioning what's behind their advice or their recommendations, if you hire a fiduciary, you can feel comfortable that whatever decisions that they are recommending for you, they believe are going to be in your best interest.
Mm-hmm. Definitely, and it makes it a lot easier and more effective, I think, for the firm like ours that always operates in a fiduciary standard, or it doesn't have to get put in a position like where I was previously, where there's different platforms, and in one, yes, client, we are fiduciaries, and this one, no, we're not. So here it's easier to just always say best interest of the client. The next question revolves around looking into complaints or any red flags essentially for your advisor or firm you're considering or are working with, whether it's through FINRA, the SEC, or a state and regulatory agency. The one piece I'll add here is it's pretty easy to find online, typing it on brokercheck.com or other areas to see, hey, this advisor has red flags or dings that come up, or this firm does. And Bill and I were talking earlier, and Bill brought up a really good point where it's really easy to find an advisor who doesn't have any of these things, right? And if they do, probably ask and talk to them about it, right?
Yeah, that's right. And I think that this is a pretty easy one, a pretty obvious one. If you find somebody that, whether on their disclosures or you go to the broker check and you see a litany of complaints or issues on there, there are a lot of us out there, right? And there's plenty of choices. So those would be pretty easy criterion to look at, to just say, okay, I'm going to move on to the next person. But to your point, if you do engage with somebody and you feel like you have a good rapport and you like and trust this person, but they do have a blemish on their record, you have every right and kind of responsibility to yourself to ask them about it and challenge them on that. And they should be able to explain what happened, even if it was something that they did wrong, to be able to talk about that. If they won't, then I think it's pretty clear to you just move on.
Definitely. The next questions revolve around service. So the first one asks, how many clients do you have and what is your communication frequency? So this is a big one to get a feel for the bandwidth of the firm or advisor that you're going to work with. You know, does this person have 1 or 2 clients? Why do they have 1 or 2 clients? Are they just starting out, or do folks just not really want to work with them? Or does the advisor have 500 or 1,000 clients, and will that get in the way? Some advisors can, you know, be fine and manage more and more clients as long as they have the right team in place. They can get that service out there. But yeah, I mean, knowing that up front is helpful. And what's your communication frequency? Are we going to talk twice a year, once a year, every quarter? Knowing that and then seeing that come to light, and the advisor sort of puts their money where their mouth is, and they do meet with you regularly and talk through changes and help you with those. Those are some things that I think about when I read that question.
Yeah. Understanding, as you said, the bandwidth, and also, you know, the more clients you have, obviously you need to scale your business, and there are different ways to do that. You can make every portfolio look essentially the same. That's one way to scale, but you might be giving up some customization and control to work with somebody like that. Or like at Fort Pitt Capital Group, we are strong believers in division of labor. So you and I don't make day-to-day investment decisions for our clients. We have a team of people who do that. That gives us more bandwidth to meet and serve our clients. We also have pretty big service teams to help take a lot of the pressure off. So those are all things that go into it. But clearly, someone who has been very successful, they're going to have a lot of clients, and it's a legitimate question to ask. Like, okay, am I going to be big fish in a little pond, or am I the bottom person on your list? I know I'm the last one in. Is that going to affect things? And then communications frequency. We touched on this a little bit earlier, but just having that expectation. How often are we going to meet? How often can I talk to you? Am I going to be able to talk to you, or am I going to get an 800 number or somebody else on your team? These are all legitimate questions to ask and understand upfront.
Sure, that's huge. Yeah, am I just in this meeting right now, to go off what you were saying, am I just in this meeting right now with this person in front of me that's talking to me and selling me on this, but then once I sign the dotted line, who do I work with? Do I still work with him, or do I work with her or him? So it can really, yeah, it's an important question and thing to be aware of, that we've heard of and seen, where someone might really want to work with this person, all of a sudden they sign and they don't really talk to them anymore. Well, yeah, what happened here? So
I've been in a position where my job was to get you to the altar and then marry you off to somebody else, and I wasn't comfortable with that. It's one of the reasons I left, but I always kind of felt like that was a bait and switch for my clients. They feel like they're building a relationship with me and I with them, and then I don't want to see you again unless you have more money. That's not really, it's kind of disingenuous. So again, asking those questions up front, and that's the whole point of this webinar, is to give you some ammunition if you are looking. What are the things to ask?
Definitely. Definitely. Bill, I want to throw this one to you to start. Do you outsource any of the decisions impacting my account? If so, who will be making decisions on my behalf?
Yeah. So I kind of characterize this bullet as the cookie cutter or one size fits all type of portfolio versus customized. And again, I alluded to this on the last bullet, but at Fort Pitt Capital, you and I, we're advisors for our clients, but we're not the money managers. We're not the ones making the investment decisions.
Right.
So explaining to our prospective clients about our process, that we have a team of people who, they're the ones who sit in front of screens all day making those investment decisions, communicating them to us, but so that we can communicate those to our clients, but not having to worry about, what's the market doing right now? We're on this webinar, and how do we manage that? So in a way, at Fort Pitt Capital, we outsource our decision making, but we do it in-house. So it's a little bit unique. But if New York, an office in New York is managing the money, what kind of access do I, as your advisor, have to them? And what kind of customization do I have? Can I call them and say, my client needs to realize some capital losses now. Can you do that for me? Or are they going to take that call? Knowing that and understanding that ahead of time is important.
Sure, and I will speak to that a little bit here. That's been great. Last almost 2 years that I've been here, it's been awesome to have that ability to go to an analyst, whether it's a CFA or someone on the team that can weigh in, or for someone who wants to get a bit more analytical, you can have one of those folks on a call and talk more in the weeds about investments should you need to. Capital gains, as Bill mentioned, they're there and you have access to them. Whereas if it's outsourced for my technical term, being that it's not really in the firm, it could be really difficult to talk to them or get them on a call and work with them, or impossible to. So that's been huge here, and it's helped me and my clients, I feel, a lot already.
Yeah. And things like tax situations, things like charitable inclinations, all of those things might affect how the potential client wants their money to be managed. And a rule of thumb is the more that's outsourced, the more arm's length you have between those decisions and that control. It's going to be a little more difficult. So again, we're biased because we like to have that control for our clients, and we think that they benefit from that. But
Sure. What about my personal situation might influence your investment recommendations? The big one that comes to my mind is, what is your income need, right? So there's tons of examples you could make here, but one could be, hey, you're 5-ish years out from retirement, or less, or a bit more, and you start thinking, okay, I need my portfolio to generate $50,000 per year for me, plus my Social Security, and plus maybe a pension for me to live comfortably. That will certainly influence our recommendations versus if you don't need anything, or if you need a lot more money. That's one idea for it.
Yeah, and I think that's a really good one. People will often ask, I'm 55 years old. Should I be 75% equities or something? How do I how do you decide that? And we really want to understand, what are your goals and objectives, and that's how we back into our overall investment decisions. Your asset allocation, how much do you have in cash, bonds, stocks? It's all a stock portfolio may look very similar to somebody else's stock portfolio, but how much you have in stocks is going to be different based off of your particular need and goals and objectives.
Sure, it's not just based on age, right?
Not necessarily based on age or any kind of risk tolerance. It's more about need and matching up liabilities with time horizons.
Totally. Yep. Lastly, do you have an investment committee, and do they meet weekly to stay vigilant on the market changes? The piece I'll add here is, yes, we do have an investment committee. It's really the asset management team. Us, as advisors, along with the investment management team, meet at least twice, or bi-weekly, I should say. But they're constantly checking and screening and looking at stocks and deciding what to trim, deciding what to add. So they are all over it. And barring any big tax situations or restrictions that you may have as a personal investor, they're able to see a change, make a change, and do it quickly rather than needing to make phone calls or waiting for the go-ahead. They can make those decisions in real time while we still feel like they are optimal.
Yeah. And one point I'd like to make on this bullet is, in my experience over time, big events in the macro events in the markets, a lot of times will influence advisors. And if they don't have a really good team of people who stay current and diligent and vigilant on changing market conditions, we often see that they're fighting the last war, right? So they are trying to prevent the big thing that already happened. It's probably not going to be the thing that gets you the next time. And so staying ahead of the curve and staying current, and if you have, like we have, a group that is responsible for doing the research, them keeping us current is really important, so that we are, we're not fortune tellers and we don't have any working crystal ball, but a lot of times, once that horse is out of the barn with whatever already happened, if you're trying to use a strategy that's going to prevent that again, you're going to end up with poorer results.
Definitely. And as you were talking there, I thought you need to decide, as the potential client or current client, I think, what involvement you want with investment decisions. Do you want your group to manage it in real time, make those changes, and do things as they see fit, or do you want to weigh in on those decisions? And I think that there are certain pitfalls to the latter, unfortunately, while you are engaged in the decision-making process. If for whatever reason you aren't replying, or the firm has too many people to call to make a change, that may prevent you from having the change in a timely manner when it actually should have taken place in the first place.
Yeah, and to take that even a step further, Cory, if you are on the fence about whether to hire an advisor, just understanding that there are firms out there that have committees that meet regularly to go over this stuff because it's important and because it impacts portfolios and decision-making around portfolios. If you decide that you aren't going to hire an advisor, just understanding that a lot of that responsibility is going to fall on you. Mm-hmm. And I'm not talking about just watching Fox Business or CNBC. I'm talking about actually doing research and staying current with legitimate news sources and research sources, and it's a lot of work.
Yeah.
Again, you can do it more easily today than ever before, but it's still it's a big responsibility. So as you're making these decisions, understanding the weight of those decisions.
Yeah, and there's, at that point, there's Bloomberg terminals out there, and probably other things too, but just a Bloomberg terminal, which we have a few in-house, other firms have them too. Some firms may not, where they cost approximately $30,000 a year, somewhere in that ballpark, for you to purchase and stay on that subscription. So if you type in a ticker such as Apple, whatever it is, you can find out tons and tons, basically any numbers question that you had about the company. What was their revenue? What was their net profit, et cetera. So there's certain things that do give firms of some scale the edge, I think, to have that information at their fingertips. Right. But so I see another question came in. It's a good time to kick off into Q&A, I think. Let's see here. Where are we? We're at 12:45. So you do have us for 14 more minutes. Not that we'll be here this entire time if it isn't needed, but feel free to type in some questions right now if you want. I'm going to address this most recent one. But yeah, if you're thinking of anything or want to throw something out there, Bill and I are here to help answer and clear that up for you. So this question, let me go, okay, Q&A slide here. So let's see, how often, yeah, I'll get to you, Bill. How often do you change, adjust the makeup of a portfolio from the initial structure design based on market fluctuations?
Yeah, so one important way to start that is by saying that at Fort Pitt Capital, we take a long-term view. So we're not going to let short-term temporary changes affect our decision-making. But the flip side of that answer is that we're constantly doing that, right? So you, Cory, may be 65 years old and just recently retired, and you need $50,000 a month from, or yeah, that'd be nice.
Nice retirement, yeah.
$50,000 a year from your portfolio. Fundamental structure may not change very much between cash, bonds, and stocks, but the decisions that we make within the stock portion of the portfolio, and if we have a stretch of 3 or 4 years like we've had in the last decade where the market goes straight up, yeah, we may want to rebalance and take some of the winnings off the table and put that in the safe pile, growing your overall pile, and vice versa. If clients have been sitting on a lot of cash and we have a year like last year where the market gives us some opportunities to buy some things on sale, we may reach out and say, let's take advantage of that too. But it's all within the context of understanding the client's long-term goals, and it's the portfolio today and for the future structured to continue to meet those goals.
Sure, and we do tend to be long-term investors, right? 3 to 5 years out. We want to buy a stock and hold it for a long time because that doesn't mean that we're going to forget about it and keep it there forever. But we are making decisions, and Warren Buffett spoke to this a little bit, and I'll butcher it a little bit, but he basically says, if you gave somebody like 20 trades in their whole lifetime to make, I'm sure that you would trade stocks a lot less often than just being in and out of them. Not that we view it that exactly, but we do view it similarly to the point where we don't want to buy something and be out of it in 30 days or buy something and be out of it in 60 days. We, are longer term holders, but we're not afraid to make changes. And one example that I think of last year with a stock that we had in taxable accounts specifically, something we do is tax loss harvesting. So there was a stock that was actually lower than where we'd like it to be at, but we didn't feel like it would really pop in the near term. So we recognized that loss so that on your tax books, you could have that and have it help your tax situation. And we bought back in after the allotted time. It was like 30, 31 days went by. And that one worked out really, really well. And, now that has really elevated and we have a loss on the books, and that's going forward still strong. So we still believe in the company. It just didn't work out in the short term. So those are some things that we're capable of doing and that we've invested in folks like that to do for us and for clients.
I think that to get to the heart of the question, how often, it's really based off of opportunistic and market conditions more than a regular time frame. So, you talked about when we buy a company, and put it in a client's portfolio, our expectation is to hold that for a very long time. We probably spent months to years researching that company before we even decided to buy it. So we're really marrying that company, and we want to have that kind of long-term relationship with it. But short-term, the market will give us opportunities either to, if it does really well, we can trim that position, take the profits, put that elsewhere, or in the example that you gave, something that we really like long-term, but it's not performing very well right now, we may add some money to it, buy while it's down, still with the conviction that over a meaningful period of time, it's going to do much, much better. But we don't definitely want to let the short-term market winds dictate how we do things, because you're much, much more likely to get whipsawed, and that's rarely works out well. I always tell when clients ask us about timing the market, I'd say, I wish we knew how to do it. If we did know how to do it, we would do it, but we don't know anybody that does that well. So we're going to be a little more patient and disciplined than maybe some people think. But I wanted to go back, if we could, to the one of the first questions there, how to understand the need to change advisor or to choose a new advisor. And I guess one thing that I would say, we gave you a lot of specific questions to ask, but the big picture is to think about, where am I in my life, and what are my needs? What am I looking for from my advisor? And is my current advisor meeting those? Can they? And if they aren't, or if I haven't hired an advisor yet, am I? So it's really doing that introspection to say, okay, what are my needs? What do I want to get from someone? And am I getting that now, either from myself or from my current advisor? And if not, that at least would probably spark a conversation if you are working with somebody now, to ask them, hey, I don't feel like I'm getting retirement planning, and that's something that's really important to me now. Is that something that you can offer to me? And if it's not, then you might want to find somebody that is, as an example.
Definitely big things to think about and ask an advisor. All right, so some last notes. I don't see any questions or other questions that have trickled in here. Another upcoming webinar we have is about, should I sell my business? It's on the 23rd at 12 p.m. And yeah, really, Bill and I want to thank you guys for being a part of this today. Thanks for your time. Thanks for listening in. A couple of big points. I mean, those key questions that we just outlined to ask your current or new advisor that you're looking into are huge. And I think if your person doesn't wear too many hats, that can go to your favor. And then understanding what you're paying for what you're getting is really important too. But yeah, again, we really appreciate your time. My information's here. Please feel free to reach out to me or Bill. We can float these here a little bit longer, but it's basically our personal. So you go to our company website, you can find all of this. But yeah, thanks again so much. Really appreciate your time, and hope to talk with some of you guys soon.